All right, let's kickstart the first conversation of the day. You'd be surprised at the number of times I've had a conversation with somebody about their personal finances, and the number of times I've been told that the person is doing an SIP and they think of the SIP as an investment rather than an investment method. They think that they're investing in SIPs. So let's clear the doubt. I'm sure a lot of you know exactly what I'm talking about. You know what SIPs are, but it still bears talking about. What is the best way to deploy funds into investment vehicles? Join me to talk about these various options is Feroz Aziz, the Deputy Chief Executive Officer of Anand Rathi Private Wealth Management. Feroz, thank you so much for taking the time. Happy Friday to you and good evening to you. We're talking at a time when there is tremendous volatility. We're seeing there are seesaws in the equity markets, not just here in India, but globally. First of all, before we get into the conversation about SIPs and lump sum, what advice are you giving to your clients right now?
So, good evening, Alex, and a happy Friday to you as well. When we look at volatile times, of course, since we are in the business of giving advice, if not advice, at least the distribution, which automatically has an incidental piece of advice. Point one, which we tell people is when you're in the eye of the storm, you can't see opportunities that easily. Please look at data of 20 years, 25 years to understand the characteristic of the animal you're dealing with, which is equity. So if you look at the last 22 years of this century, every year the markets have retracted from the peak to trough every calendar year, average of 20%. So it's not such a surprise to somebody who has seen this data before he enters. People are surprised only if they've not seen this data. The average fall for the last 20 years, every single year average, is 20% from peak to trough. So this is not unusual for you to see 18,600 coming down to 15,800 yesterday, and today at 16,250. So that's point one. So if you're prepared for something, it doesn't give you a surprise. Point two is to look at the more important variables, which do not create a decibel news, but are very important. If you look at this financial year, which went by, which still companies are giving results for, has given a 45% earnings growth, which is the best I remember in the last decade. 45% earnings growth. Nifty's earnings have gone up from 518 rupees in FY21 to almost about 750 rupees in FY22. That kind of growth definitely gives you the confidence that the markets are not frothy and they are fairly valued at even 19 PE. So we give courage so that people don't, in retrospect, regret having missed the opportunity.
Point. And in fact, it helps to put things in perspective with data. This is very important. But let's get into the nitty-gritties of this conversation, because I want to talk about how an individual should ideally look to deploy funds. And I guess even here, Feroz, data will help to understand this. So as I understand it, there are two ways that you can look to deploy funds. One is in a staggered manner through an SIP or an STP, and the other is through a lump sum approach where you see an opportunity and you deploy large sums of money. Are there any more? If there are, please let me know. And can you describe which is the better avenue here?
Alex, like you said, data gives you very good answers, which is not going to be derived out of one's gut or perception, but data helps you make prudent decision making. Now, if you come to lump sum investments, SIP investments, or a combination, which could be called a systematic transfer plan, which is somewhere in the middle between an SIP and a lump sum, to my mind, all these are armory. If you're going to a battle or even a war, you're going to carry all your armory. Will you use one, and when so, is going to be dependent on that particular circumstance. But are these armories relevant for everyone at different points in time? To my mind, yes. Now, so to conclude, I'm just saying, Alex, that all of them are important. It will depend on the circumstances and that individual at which point in time he can use that armory. Now, how do we decide that? Whether lump sum is a good idea at this point in time, or a systematic investment plan, or a systematic transfer plan. So a lump sum can be made if the fundamental value of the market is higher than the current market levels. So what at Anand Rathi we do is we compute at every point in time what according to us is the fundamental correct level of Nifty, which incidentally comes to 16,500 to 16,700 today. If the market is below that fundamental valuation, which we come at with a lot of exercise, we go in lump sum investments. If the market was greater, like it was in October, when the market was greater than the fundamental level it could substantiate, we were requesting people to stagger their investments. Hence, SIP and STP was a better armory in October, November last year, and is a very good armory. Is not as good as an armory today, and lump sum is a better method to invest.
Okay, that's well put. And you've also very clearly described the level that is fair price for the Nifty 50, which I hope people have paid attention to. But there are benefits, there are pros and cons of both. So, would you like to describe the benefits of a staggered investment approach, SIP approach, for the long term? If you zoom out, and of course, we like to zoom out and tell people to zoom out and look at 20 years and building wealth over that period of time. So, talk about the pros and cons of doing this.
Wow, Alex, that's a very good analogy. Zooming out, I'm definitely going to be using this. Yes, I think everybody should zoom out and look at the larger picture. And when it comes to SIPs, there are several advantages of an SIP. One most important advantage is that you're not committing your current income. You're committing your prospective income, which comes on a monthly basis. So there is a certain degree of discipline this commitment brings in. That's point one. Point two, because of that discipline, you are also permitted to look at smaller amounts, as small as 500 rupees. So your potential incomes are disciplinedly committed to an investment, which is great. The third advantage is that you are going to be averaging the cost. So the market is going to be volatile, and that's the nature of the beast. And we have to accept and embrace that behavior. But when you do an SIP, you're going to be buying lesser units when the price is higher. When the price is lower, you're going to get more units. So in turn, you're going to be averaging the cost beautifully, and that's called rupee cost averaging. That's the third advantage. The fourth advantage is the flexibility. You're not committed to actually do it every month. In case I am doing an SIP and that particular month there's no money in the bank account, the mutual fund guide does not penalize you to skip an installment. That doesn't happen in insurance. In insurance, I'm not allowed to skip an insurance premium. Otherwise, my policy can get forfeited. Here, the flexibility is there. These are a few of the advantages. And I think every one of us who have a recurring income should have a recurring investment plan already in place.
Given us a lovely table which we have just showcased on the screen, and it helps you over a period of time to average your cost. What about lump sum investments? And you've mentioned that now with the Nifty 50 at just about 16,266 as we speak at close today is still below what you have computed as the fair value, right? So now would technically be a good time to say a lump sum makes sense. What are the advantages of that? And we've seen the Nifty 50 actually fall to 15,800 also over the past couple of weeks.
Yes. So, when you're looking at a long-term time frame, let's assume an investor is investing from a 5-year perspective. If he invested today and tomorrow if the markets are 3% down or even 500 points on Nifty down, it is a certainty that someday it will come back. So it's only a matter of time, because all peaks which we saw from where markets corrected, it took an average 299 days to recover from the peak. Again, data, Alex, we're not showing the chart, but we looked at the data of each fall and we saw what is the average time the market takes to correct back. 299 days, which is less than a year. So if I put my money lump sum, as long as I have the courage to not get bogged down about what happens in a week, 10 days, 1 month, then it's a good strategy to go all in if you get values lesser than what you believe the commodity is worth. If you're going to get a discount in a store, you're going to go buy that shirt if you really want it. And you'll be waiting for that discount. So when you get that discount, and if you think the commodity is worth X and you're getting it X minus something, you can go lump sum in certain periods. because even if it goes below the purchase price, it is a near certainty or actually a certainty that it's a matter of time, 1 year, 2 year, 3 year, and after 5 years it will recover. But the converse is not true. If the market went to 17,000, it is not going to be true that 15,800 will be a level market will show again. For example, in August 2020, when the pandemic was just finishing from a market standpoint, we were very, very bullish because the earnings growth were beautiful. At that point in time, when Nifty was 9,500, it was the eye of the storm. But now, will Nifty again show you the 9,500? May not be. So several HNIs stayed sitting on the fence and missed out that opportunity. So we don't like to miss out opportunities. So lump sum investments become a right armory in bad times from a market standpoint.
It takes a little bit of courage, doesn't it, though? If you're talking about lump sum investments, of course, it helps, Feroz, for somebody to come to you and say, hey, Feroz, you've seen so much more than I have, and do you think that this is a good time? But if you are to deploy a significant chunk of your wealth, and there is a lot of noise that suggests that you could see a bigger fall. People are talking about the RSI at a certain level. They say that it could fall to 30. It hasn't yet fallen to 30, and therefore it could fall further. It takes a little bit of courage.
Can't agree with you more, Alex, because you've been speaking to several people, so you're able to get the nerve right. Absolutely, it takes immense courage to put your money when there is turbulence, when there are so many concerns. It's very difficult, and to address that comes the asset allocation. See, if you're going to put all your money in equity, then it's surely not something which you can do as a lump sum investment. People generally have, in India, if you look at the HNI data, only 30% of their money is in equity. Now, the 30% does not need to be staggered, especially when you get a commodity lower than the actual price, in your own opinion. So, asset allocation helps you control the risk. If you have, let's assume a 50-50 equity debt allocation, in 3 years' time, even if the Nifty is down 20%, after 3 years, you will not lose capital because the debt will make enough money to protect the equity. So, you use the comfort and the stability which debt brings. In India, you get interest. Today, you can lend to Government of India and make 6.5% post-tax in several funds after indexation. That gives you the risk cushion to put your money in equity. If you were in Switzerland, that was not going to give you that 7% post-tax. So it does not give you the cushion for equity. So Indians have that inherent advantage of using debt as the Sahara, as they call it in Hindi, to make your equity allocations and still not lose capital after 3 years. Even if Nifty is down 20%, you will not lose money. Is that not courage enough mathematically for you to take the plunge and get into the pool?
If you make it formulaic, it then makes so much more sense. It's much more logical then. I want to talk about the construction of an ideal portfolio. And of course, you need to have so many different parameters that you look at on an individual basis. And an individual has to identify what their risk-taking capability and profile, etc. is. But there should be certain ground rules that everybody can follow, right? What are they?
I think the first learning I've had, of course, in the last 18 years, in the initial part, I didn't have this learning. Most of us as individuals embark on a path without actually having a clear framework of the destination. So having your goals right is very important. People get very carried away with certain products and buy those products without understanding the fitment into the overall portfolio. The first suggestion I have as a ground rule is to have a goal. You don't leave your home and see Google Map. Google Map also does not suggest you a path unless you fit in the destination. So put clearly defined destinations for yourself. So that's where the path emerges from. That's first suggestion. The second is understand your risk appetite. The risk appetite has to be understood mathematically. Unfortunately, our industry or we in finance use risk as an English word, high, medium, low. Risk has numerical integers assigned to it, just like return. So understand the risk appetite. What are you okay to lose in 6 months to make in 10 years? What are you ready to forego in the short term to make wealth in the long term? I was just hearing Madhu in the break, and then he said wealth is created in the long term. So that's your risk appetite evaluation. Third, you have to have backward calculations using inflation. Inflation is an under-respected risk. In India, in the last 40 years, you need 20 times more the money to buy the same commodity. In 1979, what you needed only 5 rupees, today you need 110 rupees to buy the same commodity. So respect inflation, work backwards, and arrive at what's the investment you need to do today to fulfill the dreams or destination which you fixed for yourself.
Fantastic. I think you've hit quite a few nails on the head. Just a few more points on the choice of product when you're let me rephrase that. If you're talking about the SIP route, and I want to understand this, right? Because we generally talk about SIPs in mutual funds, we're talking about equity mutual funds, but it's also a mode of averaging, like you've pointed out. Can you have a strategy that you employ for fixed income as well as, for example, a stock portfolio that you hold individually?
Alex, the answer to this question of how I see it, right or wrong, is it's a cycle. You invest lump sum SIP in equity. When your goals are closer, you move that lump sum to debt. And once you want to consume, you do systematic withdrawal plan from debt. To answer your pointed question, is SIP relevant for debt? To my mind, no. SIP is relevant for equity. Lump sum investments are relevant for equity. When you're just 2 years away from your goal, you move the equity allocation to debt allocation. And from debt, you withdraw the money in the form of systematic withdrawal plan. So that's the investment cycle and the asset mix which helps you fulfill. So I would never do an SIP in a debt fund. I would do it in an equity fund, which is in the accumulation phase. I would love the systematic withdrawal plan from debt funds, which makes it so tax efficient that you get taxed at 3-4% on an aggregate basis for the current credit in the bank account.
I mean, beyond the 3-year period, right? If you're talking about long-term capital gains on that on fixed income product, I want to ask about the last bit, which is we started this conversation about equity going down, and a lot of people, Feroz, who have entered the equity markets, young individuals who've probably taken on higher risk than they might have been okay with on an ordinary basis if it wasn't a roaring bull run. Is this a time also for introspection? You said that when you're in the eye of the storm, it's not really a good idea to do very dramatic things. But is it time for introspection, according to you? Look at your risk profile, identify what it is.
See, I think it makes more sense to look at risk appetite and expand the risk appetite. Most often than not, people look at risk appetite from the short term. Let me give you some more data. We analyzed 5 equity funds, which started in 1992-93, which is about close to 30 years. And then we checked, these were the private sector mutual funds, the first few. We found out and we made sure that we see different 10-year investors. If somebody invested on any particular day and sold it after 10 years, the most unluckiest investor, who had the capacity to hold for 10 years, the per annum return was 11%. So what's the risk we are speaking about? If you have a 10-year holding period, the unluckiest guy who has held for 10 years has made 11%. The luckiest guy has made 32%. So the risk is when you meddle with it, when you plant a tree and then pluck it back to see whether it's growing and then blame the tree for having not grown. So point I'm trying to make is 10-year investing in equity is negligible or no risk to equity capital. But definitely you may lose opportunity of not making an FD return if you're really unlucky. But if you get into equity markets at these times, not at the peaks, it will not disappoint you as long as you can hold your emotions tight for a 5-10 year period.
And I'm taking that analogy. Don't uproot the tree just to see that it's growing. Thank you so much, Feroz, for taking the time. Appreciate it.